I'm going to explain very simply what IULs are, but in order to do that, we first need to have a basic understanding on how life insurance works. So if you have no idea what an IUL is at all, it is a type of life insurance policy. IUL stands for Index Universal Life. Now, before I get into a brief description of what the IUL is, we're going to take a step back and just explain how life insurance works in general. If this is the first time that we are meeting, my name is Nobu Musekiwa. On this channel, I answer your questions about cash value life insurance, including IULs. If you're interested in working with me, there is a link in the description. Overall, there are two major types of policies that you can have. You can either have a life insurance policy that is temporary or a life insurance policy that is permanent. A temporary policy means that you are paying the insurance company for a specific amount of coverage for a limited amount of time. So it could be 10 years, 20 years, 30 years, whatever that number is. The insurance company is agreeing that if you die in that time period, let's say it's 10 years, then they will pay out to your beneficiary. If you die after that period, they're not paying anything because your contract is for that specific short amount of time. So those are the temporary policies. They tend to be a lot cheaper because the risk for the insurance company is less because they're only tied to you for a short period of time. The other types of policies are permanent life insurance policies. What that means is once you are approved, as long as you continue to make your payments per your contract, that life insurance company is going to pay out to your beneficiary no matter when you die. So it doesn't matter if you die when you are 35 or you die when you're 85, they are going to pay out according to your contract. So an Index Universal Life policy, an IUL, falls into the category of a permanent policy. So once you have it, the insurance company is gonna pay out no matter when it is that you die, as long as your policy is intact. With any type of permanent policy, you have an amount of cash that builds up over time. So the way that that cash builds up is going to be different depending on the type of policy that you have. But with an Index Universal Life policy, the way that the cash builds up is, you determine how much you're going to put in each month. Part of that money goes towards paying for the life insurance because this is a life insurance policy. And then everything above and beyond that goes into a savings bucket, if you will, where the interest that is credited to that savings bucket is based on how well the stock market is doing. So if the stock market is doing well, you're going to get credited that interest. If the stock market goes down, however, that doesn't negatively impact your money. It just stays the same. And so what some people like about the IUL is that you have the potential to gain more versus other permanent policies, but there's also the downside of that interest that's credited to you is not guaranteed. It's going to vary depending on how well the stock market is. And so an IUL may not be for you if you don't like that risk. It may be more beneficial for you to get a cash value life insurance policy where your interest is guaranteed. Generally, the older you are and the less you're putting into the policy, the less beneficial an IUL might be for you. Just depends on what your goals are and what you're trying to accomplish exactly. Besides being able to take advantage of stock market increases without actually having your money in the stock market, there are three other major benefits to having an Index Universal Life policy, and I go over what those benefits are in this video, so make sure you check that out next, and I will see you there.